Good morning, everybody. Bo Lebers here, health insurance broker out in California. Today I have the privilege of hosting SAGE, a CEO networking event down here in San Diego, California. They're going to have a panel of experts in the real estate industry speaking to how to invest in today's economy. I'll be filming a lot more of the presentation and sharing a bit, so stick around to learn more.
For over 30 years, Damien has grown his reputation as a trusted commercial real estate advisor by taking a fiduciary approach. He's served some of the most powerful brands that occupy industrial and office space. Changing lending environment, what should real estate investors expect from banks in the near future?
All banks are not created equal, so the conversations are going to be different at each bank. I want everybody to understand where we've come in the last 12 months. Banks need deposits to fund loans, right? It's a pretty simple business. You can't grow a bank if you don't have sufficient deposits. But what some of you guys might not know is that banks can borrow from the overnight Fed window to write their balance sheet on a daily basis. Banks were able to borrow from the Fed overnight window a year ago at 0.3%. So it's pretty easy to do a loan with a 4 in front of it, make money. The overnight borrowing rate right now is 4.83%, right? It's a 4.5% or whatever increase. So you talk about loans having a 6 or a 7 in front of it. That's why, because there has to be profit built in. You've seen a lot of things in the news, but the truth is a lot of banks are coming off kind of record earnings last year. So a lot of bank balance sheets are pretty solid. Their earnings have been there. But what's yet to be determined is how this last panic impacted banks. Bank costs of funds were very low historically the last few years. But now that everybody's on to the let's get a return on our money game, the cost of fund inside the banks is kind of skyrocketing, right? And that's what's driving a lot of the interest rates too.
Tend to work together in the sense that oftentimes people that can't get a traditional bank loan, who may be a good customer,
Right.
could be referred to someone like
Absolutely.
Brock. So Brock, would you kind of share what you're seeing in this kind of market?
So I'm a half glass half full kind of guy, all right? And I look for opportunity in the marketplace, and there hasn't been more opportunity in the private debt space since I bet about 2010, when the capital markets were in complete disarray. They're in complete disarray right now. We're coming off COVID. We're coming off a banking crisis right now, and especially here in San Diego, we're coming off a supply-demand crisis. We were talking about banks trying to assume loans. I promise you, those banks don't want to assume those loans. They don't want to they can redeploy that money at a much higher rate. They want out of those loans. So they're going to make it as difficult as possible. And I'm interested to see what the story is to allow that. They're going to go back into all the covenants and allow them to be assumable. I see. So my job is I'm investing on behalf of private high net worth investors that want to deploy capital into debt. Okay, they're looking for cash flow. They're looking for market returns right now, and the debt that we can put out in the market are going to be mid 10%.
Jason, what about multifamily? What are you seeing there?
Honestly, in multifamily, as you all know, rates have doubled since beginning of 2022, and we haven't seen any softening at all yet. We're still seeing prices up from last year. We're still seeing buyer confidence, but we're slowly seeing that come down recently. Transaction volume has significantly decreased. There's a lot less buyer confidence out there just because simply the cost of capital has gone up significantly. I mean, First Republic is the #1 multifamily lender in San Diego, and they basically priced themselves out of the market. We refinanced the 6-unit building 6 months ago at like 5%, and now any new loans that come across our desk are charging above 7%. So that's going to have a huge effect on the San Diego multifamily market.
Units are properties sitting longer right now, or the days on market, is it a lot longer?
Yeah, they are sitting longer, but there's also no inventory. Like there's not a lot.
That's what I was wondering. That's why I was like, are they moving or are they just still sitting?
Well, the properties we're kind of calling it the flight to quality. So we're seeing properties in great locations like Pacific Beach,
Okay.
North Park, like good markets in San Diego. We're seeing those like fly off the shelf if they're priced correctly. There was a 7-unit building on Florida Street for like $430,000 a unit, which is considered expensive for a value-add building. And there were 7 offers on it. But there's properties in like City Heights and Canto, El Cajon, Spring Valley, the lesser markets. Those buildings are sitting.
Okay.
There's a huge investor out of LA that's unloading a lot of their Class C assets, and he can't sell any of them. So yeah, we're seeing location matter a lot right now.
Well, it was a great event with Sage this morning. Hope you learned a little bit about the real estate economy locally here in San Diego. Thanks for watching. Don't forget to subscribe and share. Cheers.